Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. Welcome to another one of these informal videos where we're trying to make sense of what's happening in the stock market right now and maybe make a few bucks in the process. Really excited about today's video because we're seeing a lot of buying interest from some big money investors. And in fact, I just got tipped off recently to a secret private equity meeting of investors and got the inside scoop on some of the major trends that these people are following. I also want to invite everyone to join our private Facebook group. That's Let's Talk Money Together. We're over 5,000 people in the group, and it's more of a one-on-one conversation, more back and forth than what we get here on YouTube. So I'll leave a link in the video description below, or just go to Facebook and look for that Let's Talk Money Together group. Again, though, today I want to share that secret private equity meeting with you and reveal those 4 major trends that these investors are watching. Now, this was a March investor meeting by Bain & Company, which, if you don't know, is the private equity firm co-founded by Mitt Romney. So where he really made his millions. We'll look at those 4 industries, these big money players that they're looking at, and why we could just see a wall of money coming towards this industry and all the stocks, all the companies within those trends. I'll also be revealing 3 stocks being bought by billionaire investors. So 3 big money investors here making some really big bets, and frankly, actually why I probably won't be following them into these 3 particular stocks. So make sure you catch that towards the end of the video. So about a week ago, I got tipped off to that secret meeting for Bain & Company investors. And for those of you that don't know, private equity is a special type of investment firm that buys up distressed companies. So companies that maybe aren't competing, aren't doing as well against competitors. So they swoop in, they buy up all those shares and take the company private. And this is what happened to Kraft Heinz about a decade ago, just after the financial recession. A company came in, bought up all the shares, and took it private. Then they'll change up management. They'll maybe sell off some of those unprofitable brands, unprofitable business lines, really try to turn the company around. They'll clean it up. What they'll do, they'll use a lot of debt to buy up the company when they buy it. And then they'll load even more debt onto it before taking it private again, or taking it public again, so issuing shares to the public. So one thing you always have to do when you're looking at stocks that were recently made public from a private equity firm, you need to look at that balance sheet because they generally have tons and tons of debt on their balance sheet, and it's really hard to get out from under that. Essentially, what the private equity firm is doing is they're cashing out a lot by just loading up this company with debt. Taking that cash, they still own a large chunk of the company when it's public again, but these companies always have a ton of debt on them. So now private equity firms actually had over $2.5 trillion in cash last year, waiting to go. They call it dry powder, waiting to invest in these companies, waiting for a sell-off basically. They're waiting for companies to start showing some weakness so they could jump in and really pick up the pieces. So with companies and themes that we'll talk about in that private equity meeting. And this could potentially be a wave of money coming in and buying up a lot of the companies that we'll talk about in these themes and sending these stocks skyrocketing, right? Stocks of the companies that are going to be bought out and even some of the competitors in hopes for an acquisition or some private equity interest. Okay, and they've gotten that sell-off, obviously, over the last couple of months. A lot of good companies being sold off in this coronavirus panic, and private equity is really looking to take advantage of this. And why this is such big news, though, is because regular investors usually don't have access to this kind of information, okay? There's a securities law, an SEC rule that says only accredited investors, okay? So people with $1 million net worth or more, or a certain level of income, only those rich investors can take part in these private equity investments and hedge funds. So most investors are totally locked out of this world, but getting news of this meeting makes it possible to kind of front run those investments, get in on some of these trends and these companies before that private equity wave of money comes in. So here's a slide from the meeting, and this shows the 4 major trends that private equity is following, and we'll talk through each of these. Now, these were all trends before the coronavirus pandemic, but that whole shelter-in-place environment is really going to accelerate these, and companies in these industries are really leading the way into the future. So it's not necessarily just the idea of this wall of money coming into these companies and these stocks that we'll be looking at, but that they were trends before the epidemic. They're very strong valuation plays right now, and these are really the themes that are going to be leading us into the future. The themes of the 21st century that I think you need to be watching. So the first theme here is in home services. Okay, so you've got delivery services, entertainment, media, really anything that can be delivered into your home to serve your needs. The slide here highlights Kroger, Domino's, Netflix, but I'd actually be more interested in Grubhub right now, ticker HUB. Shares are down 30% since February, but there are rumors that Walmart and Kroger may be interested in an acquisition. So if you don't know, Grubhub is a food delivery app, which has obviously been hugely popular lately, but also over the last few years. So that idea of getting food delivered to your home, either from a large food retailer, from a grocery store, or from a restaurant. The company has over $425 million in balance sheet cash against just $613 million in long-term debt. So really a pristine balance sheet. And if you've been watching the channel over the last couple of weeks during this sell-off, I've been talking a lot about that balance sheet because during a good economic growth cycle, you can look at that income statement to see sales growth, earnings growth, really where that company is going and how well it's doing. During a recession, during a stock market sell-off like this, you need to be more focused on the balance sheet because that's really going to show you the cash on hand, the debt that this company has to deal with, and really that financial survivability that they have, that flexibility and survivability. So you want to be looking at how much cash the company has on its balance sheet, how much debt it has to pay. You can look towards that income statement for that interest expense that they're having to pay. Make sure that they have enough cash to cover their interest expense, even if revenue sales comes down quite a bit. You also want to look at the 10K, so that's the annual report for a company, and look at the debt maturities. Okay, every company is going to tell you how much debt they have, how much long-term debt, and when that long-term debt becomes due, when they need to pay that back. And what you need to do is look and see how much long-term debt a company has to pay back over this year and next. So a lot of companies that maybe can defer their long-term debt into 2022, 2023, and only have to pay those interest payments for right now. That's going to give you that cash, that financial survivability, that flexibility to get through this pandemic, this short recession, and then survive and really make those make that rebound in the future. But Grubhub, $425 million in cash on the balance sheet. Very good debt maturity schedule, so they're not in any existential threats here. And it's an app that any large food retailer would want to own. An excellent app that gets food delivered to your door. So besides those food retailers as a possible buyers, private equity is always going to like companies like this with lots of cash on the balance sheet, little debt, because they can come in, they can leverage up the finances, so they can put on a lot of debt on that balance sheet to pay for the acquisition, and then cash out before they take it private. We've also talked about Uber here on the channel, so ticker UBER, and I like it here over Lyft because it does have that food delivery component, which has helped keep cash coming in even as that rideshare component is mostly shut down. I think with shares of Uber right now, you're buying basically that ride sharing and the Uber Eats business and really getting all that self-driving tech, the AI, all the other projects that this company is involved in as a freebie. I really don't think the market is accounting for the value in those other projects in the shares right now. So basically, you're just paying for those two main components and getting a wild card on all these other projects. Now, the next theme here was remote work. So another trend that we've been seeing develop over the last few years, but just exploding recently. And Nation, I think we're going to see a lot of these stick around after life gets back to some sense of normal. After people and companies see how easy it is to deliver education online or to work from home, a lot of work and a lot of services will never go back to the way they were. Companies love the lower costs or the on contract or telecommuting workers. And as an investor, you need to be in these stocks and the companies that make this all possible. So here we're talking about companies in that networking and connectivity space. Anything that helps data flow over the internet, anything that helps connect you at home with either an education provider or a company online. They highlight Citrix and Zoom here, but I also like Fastly and Cisco. Now, I highlighted Fastly, that's ticker FSLY, late last year as one of my top picks, and shares are up 10% against that market that's down 14% over the same period. Now, Fastly provides data center and streaming media services, so right smack in the middle of that trend, Data centers are seeing an explosion in the amount of data that's going through their servers, and obviously streaming media is very important, not just for the huge companies like Disney and like Netflix, but for any service that's delivering online video content. Now, we've also highlighted Digital Realty, ticker DLR, a data center REIT, pays a 3% dividend and is up over 26% so far this year as that volume of data demand through those servers, again, just booms higher. Now, another big trend here that you want to follow is healthcare, and especially healthcare IT services, so information technology. We're talking about telemedicine, healthcare data systems, data management. With the surge in patients over the last month, it's obvious that hospitals just don't have the capacity or the IT, the infrastructure systems to handle it. So what we're going to be doing, I think, is seeing a lot of this stimulus money and private money flowing into data and IT improvement, because using that technology better, more efficiently in that healthcare systems is the only way that we're ever going to be able to meet the surge in demand from a pandemic like this, or even in the future. Now, in fact, healthcare acquisitions was 14% of 2018 private equity buyouts. Okay, so over $800 billion in that sector alone. So there's already a lot of big money interest in this space. The meeting highlighted a few biotech names here, but I think the IT side of it is much more interesting. Like we said, the IT side, so data management, telemedicine is much more novel in the healthcare space compared to that biotech theme. So I'm interested in names like CACI International, that's ticker CACI, which is also going to be in our next theme that we'll talk about. Now, the fourth trend here is network security and defense, and this has really been buried in the news lately, but we're seeing a surge in hacking and malware attempts during this pandemic. Just a lot of cybersecurity risks trying to take advantage of everyone being online and sending all that data between home and work. And it's not just about that identity theft and personal data hacking, but we've been following that trend of state-sponsored cyber attacks for a few years. I highlighted in another video in January how rogue states like Iran and North Korea are really using these hacking teams as a way to conduct modern warfare without actually starting a traditional war against countries that they can't beat militarily. So all this means that just cybersecurity is going to be a booming industry for decades, and one you want to follow. Now, the meeting highlighted Leidos, that's ticker LDOS, but I also like Zscaler here, ticker ZS, and CACI International. Zscaler is a cloud security platform that's really taking a lot of market share from those legacy providers that are still providing their security as far as on hardware. We highlighted Zscaler last year in our cybersecurity stocks, and it's up 37% so far this year. It has $384 million in cash against just $34 million in long-term debt. So again, just a pristine balance sheet with lots of cash available to survive this and really grow into the future and that strong growth. Now, CACI International operates in both the federal information technology security solutions and that HIT space, so that healthcare information technology. So it's really touching a lot of these themes that we're talking about. So those are the four trends, getting a lot of interest from these large institutional buyers and potentially some buyout attempts over the next year or so. Even beyond that idea of that private equity money coming in, though, pushing these stocks up, I think you can come into these trends, invest in these companies operating here, and just be very happy over the next 10 or even 20 years with those returns, because these are the themes that are really shaping our world right now. In fact, I'm putting the 10 names highlighted in that Bain meeting in a paper portfolio on the Webull app against some of my own picks, and I'm going to track how they do. I love this stock simulator on Webull because it gives you that chance to test out different strategies and follow some of your stock picks before putting any real money into the trade. So I'll leave a link to Webull in the video description below. Check that out and make sure you get your free share when you open an account. Now I want to look into the big news over the last couple of weeks, and we've seen 3 billionaires really making some controversial stock picks, so I wanted to talk about those. First here, probably the biggest news was Warren Buffett buying in and then selling shares of Delta and Southwest. So selling the shares just less than a month really after adding to his position. Now Buffett still owns almost 10% of each of these companies, so I'm not so sure if this was much of a call on price as it was about staying under that 10% ownership regulatory requirements for these two. I do think it's a little early to jump into some of these hardest hit stocks in travel and hotels. Even after those lockdown restrictions are loosened, which could still be a couple of weeks or even months out, there are still going to be travel restrictions, especially internationally. I talked to a friend, an executive at one of the airlines, and he thought domestic travel could be okay by June or maybe July, but it's still going to be 6 to maybe even 8 months or longer before that international travel really comes back. A better choice on a Buffett stock, though, you may instead look at something like General Motors or ticker GM. And Buffett has been buying this one since 2012 and now owns 5.2% of the company. GM is down about half from its January high and pretty much a consistent dog since coming out of bankruptcy in 2010. But this thing is trading at some ridiculously low value. Shares are trading for just 5 times trailing earnings. And granted, 2020 earnings are going to be rough, but I think this one gets back to some decent numbers in 2021. The company has paused its buybacks and cut expenses to protect that 6% dividend yield. So you're going to get paid to hold this one even while you wait for that rebound. Also in that billionaire buying binge was Mark Cuban, billionaire owner of the Mavericks and really an entertainment empire. He bought 1 million shares of Live Nation, ticker LYV. Though at just maybe $34 million total investment, I'm not so sure this one was more than just trying to promote the brand or maybe his name. I will say it would be really cool if Cuban was making a run at that broader sports and entertainment play. He already owns obviously a few networks and that sports franchise. Then if he could control ticketing and promotion through Live Nation, that would be just a huge play on entertainment. The problem here, though, that I'm not really a fan of Live Nation as an investment. It's the largest live ticketing event or live event ticketing and promotion company in the world and has a huge advantage with that Ticketmaster. But these kinds of ginormous crowd live events aren't coming back for a long time. You can get people out of their homes and back to work. But the last thing that you want to do until we have that vaccine, which is still at least a year away, is really put them in a concert hall, assholes to elbows with people. But even if we are able to get back to those live events and the festivals that this company makes its money on, the fundamentals on this thing are really scary. The company has $2.5 billion in cash and $3.3 billion in long-term debt. So not a horrible balance sheet, but the operating margin last year was just 2.8%. And remember that operating margin is the operating profitability, right? The amount of revenue left over after paying suppliers and paying operating costs. And even in a strong 2019 year, the company kept just 2.8% of its sales after this before interest and taxes. So that just does not leave much room for mistakes, a recession or not making sales for 9 months straight. Now, I don't know how much costs or expenses the company can cut back on or how much credit the company can draw to stay afloat, but it wasn't a stellar business even in the first place, even in good times. So definitely not one I'm going to be following Cuban into. Our third billionaire buy here was Carl Icahn and his 11.4 million additional shares in Hertz Global. So that's ticker HTZ. This gives Icahn a total of 39% of the company, which has been buying over the last 6 years. So as with Buffett and the airline plays, I think a lot of these were just big stakeholders trying to dollar cost average into their biggest bets. Already in it for billions, might as well add a few more million into it, right, and get the shares for a lower cost. And while I do like this one better than that Live Nation play, Hertz is still a tough call. The company has just $865 million in balance sheet cash and pays $800 million a year in interest payments alone on its $17 billion in long-term debt. So not a lot of financial flexibility on this one if business travel doesn't bounce back fast. Now, the only thing that I can think of that maybe Icahn sees in Hertz is maybe that value in the assets. So all the cars that the company owns have been depreciated on the books so much, but maybe they're worth a little bit more. So our good old corporate raider Icahn thinks the worst case scenario, he can come in, take control of the company and sell off some of those assets for a profit. Click on the video to the right for 5 more stocks I'm buying for triple-digit returns. 5 stocks with an average analyst price target of 80% or higher from the current price. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.